Friday. It is Friday. We finally made it to Friday. It is the 20th of October. After that, things get a bit tough. European equities very much under pressure. Gap down first thing this morning, and the action's pretty much been one way. It is on decent volume. That tells you a lot about market sentiment right now. It's ugly. DAX is down by 1.4, CAC's down by 1.2, FTSE's down by 1.2. It is not a good session for European equities. Is there more still to come? The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Similar theme, selling on decent volume. We're down by 1.2%. 434 is where we are now. Some interesting technicals starting to develop for European stocks. Boliden, the Scandinavian miner, down by 6.93. The lesson this week is if you have missed, you are being punished. And you are being punished in a big way. Just the latest example, I can give you a long list. And there's been some big names this week that have not delivered. Is this earnings season going to be the turning point? Stocks have held up relatively well, despite data pointing in the opposite direction. Our earnings about to confirm actually the reality of the situation. The Solar Edge story in the States has rippled across the Atlantic. You can see that with SMA Solar, just one of a number of stocks. That stock, Alex, down by 9%.
Yeah, here in the U.S., Guy, I just want to draw your attention to a level. Speaking of technical levels, 4233 is the 200-day moving average for the S&P. We are right around that level here under some heavy selling pressure with heavy volume. So just watch that level, particularly as we head into the close. You mentioned Solar Edge. This is just how bad it is. Down 30%, orders canceled. That builds inventories as ripple effects all across the industry. We're going to delve into that later on in the hour. Is this a post-COVID story, post-Ukraine story, or is this actually a higher rate story? We'll see. Also, the S&P Bank Index not doing well either. Regionals look even worse, and this is because of regionals. Huntington reported, but Regions Financial was the big loser here. Net interest income getting squeezed, earnings disappointed, getting squeezed, and all of that really having some repercussions. And Mike Mayo at Wells Fargo downgraded Regions like right after the numbers came out. So what do? There's gold buying and there's buying in the bond market. There's some dollar buying, but we'll get to that later on in the show. 2-year yield down 8 basis points, Guy.
Michael Hartner over at Bank of America putting a nice note out. We're going to talk to Sebastian Regler in a moment. But over in the States, the view seems to be, Alex, that sentiment is getting so beaten up that maybe you want to start thinking about buying the dip. But as you've just highlighted, there's some key levels, and that 4,200 level just north of it, really important. Want to flag a story out of Europe as well. I think this chart's really nice. Less than a third of 600 members are above their 200-day moving average. Let's go back into 21-22. And the blue line here is that metric. It rolls over. We get breadth kind of becoming a problem. Takes a while for equities to react to that, but they definitely react to that. We've seen a similar story as well. Look at what is happening. Fewer and fewer members above their 200-day moving average. That blue line is going down again. Stocks have yet to react in a big way. Are we going to get that reaction? The other thing I want to highlight as well is that metric, that blue line, had to bottom quite significantly before you saw any kind of a bounce. Again, that seems like it could be further away. So, yes, sentiment may be beaten up, but does it mean the market is going to bounce from here? We'll see.
Yeah, or is it just preventing any rally, really? So let's get to it. The question of the day, is sentiment bad enough to buy the dip? Well, joining us now, Ira Jersey of Bloomberg Intelligence and Ben Ram from our MLive team. And Ben is staying up super late for us, so we appreciate that. Ira, I know you're the bond guy, but the sentiment thing holds there, too. Is sentiment bad enough to buy here?
Well, I think it has been. It's one of the reasons why you do see, I think, a bit of a rally today. And I think importantly, in terms of people who are 60-40 looking for a hedge, for a long time, the bond market and the equity market was moving in tandem. When you had quantitative easing and then quantitative tightening, it was all a one-way trade where there was, except for maybe cash, there was really nowhere to hide. I think now you're coming up to a point where you will have the relationship where equities and other risk assets and and the Treasury market might actually be moving in opposite directions like we're seeing today. And this may become more of a feature for markets going forward now that we're at yield levels that seem a little bit more appropriate. And it seems like the Fed's going to be, staying away from large bond purchases anytime soon.
Alex would certainly rather be 40 than 60 at this point, but that was the conversation from the last hour.
Sorry, that was an age thing. That was a boomer versus Gen X. Yeah, I got that. That was good. That was good, Guy. Nice job.
Ven, what do you think? How do you see sentiment right now?
Well, I think that the equities are way overvalued at this point. We've got a 36% rally, for instance, in technology stocks in the NASDAQ 100. So, what was underpinning those stocks amid the Fed's rate increases was obviously the AI story and what it means for productivity, what it means for gains as a whole for America Inc. While that was kind of easy to see, what is not easy to see going forward is how do we play the war? I mean, if it's going to be inflationary and the Fed is compelled to keep rates higher for longer, then the discount rate that you apply to discount stocks, whereas earlier it was 3-4%, whatever, now the 10-year yield is at 5%. So the discount rate that is applied to stocks is much higher, and it's going to be harder for stocks to overcome that. Why is 5% significant? Because if you look at foundations and other investors, their modeling is all based on a 5% discount rate. And the higher we get on the Treasury yield above 5%, it becomes a huge problem for equities.
So then where is the biggest shakeout to be had in that? Because we've known we were getting to that level for a bit.
Well, I think the biggest fraud to come out is from NASDAQ. By my calculations, it's overvalued by about 15%. I think that fraud has to come off first and go to fair value. Fair value, according to my model, is 12,877 on the NASDAQ. I think S&P is more reasonably valued, and I think that therefore the S&P will kind of outperform the NASDAQ going into this downturn.
Yep. Ira, can I come back to the bond market with you? The bond market in so many ways has not delivered on its normal safe haven status, and that's because we've had the issue of what is happening with the data and the economy and the Fed kind of sitting on the other side of it. We're in the quiet period now. We're not going to hear from the Fed for a little while. Does that mean that over the next few days, that potentially with that side of the story removed, the bonds can go back to being the safe haven story? And is that enough? I was saying it a little bit today, but is that enough for the next few days to maybe keep that bid into bonds?
Well, I think that's part of it, but I do think that the rates market is probably going to take its cue off of the data and what's going on in equities. So I agree with the idea that at least in the near term, it could be a little bit more of a safe haven bid in rates markets. We did get very oversold, but I do think that there's still a risk, particularly with the November 1st announcement looming of additional potential supply of Treasury securities, that there's going to be some nervousness and people not wanting to jump into the market in a very big way before you wind up getting an idea for how much new money is going to need to be raised by the federal government. Mm-hmm. So I think, we're probably range bound. This is not unusual for the Treasury market to have these massive moves and then find like a 30 or 40 basis point range where it stays in potentially for months. So it wouldn't surprise me if maybe we're trying to find the kind of the top of the 10-year yield and the bottom of the 10-year yield where we might stay until for the rest of the year potentially.
So what does that range then look like, Ira? I mean, you heard from Ben that you could potentially see the NASDAQ down 15% overvalued. That's where we're at on the equity market. That range feels like it needs to be a lot higher then.
Well, I would actually think the other way. I think if NASDAQ were to sell off, 10, 15%, and, yes, presumably the rest of the equity market would probably follow that. I think that we retest 4.5% or so, at least on 10-year yield, which is, a 40 basis point rally from here. But if equity markets and the economy kind of sputter along, then I do think that there's the risk that you could have, 10-year yields even break 5%. And of course, 5% is kind of meaningless in most of the charts, but psychologically, obviously, it's a big number. It's a round number, but 5.25 would not shock me, particularly with the market pricing. What Ben was saying is that maybe you're going to have the Federal Reserve on hold for the next 18 months, and so you can wind up having what we talked about earlier in the week, Alex. It's just a very flat, uninverted yield curve that just 5.25% across the board.
The pancake. We're back to the pancake. Big week next week for tech earnings. So actually quite an interesting few days coming up. Fellas, have a great weekend. Thank you very much indeed. Ira Jersey of Bloomberg Intelligence, Ben Ram from our M Live team. Joining us late in the evening where he is. OK, coming up, we're going to get more insights into our question of the day. Is sentiment bad enough to buy the dip? Sebastian Redler is going to join us from Bank of America. Jim Jordan is having another crack at it right now. He wants to become the next Speaker of the House. Voting is underway. We will keep you up to speed with what the numbers look like. 217, the magic number. Is he going to get there? This is Bloomberg.
Buck. Emmer.
Monday, Bloomberg's Guy Johnson and Alex Steele sit down for an exclusive interview with Virgin Atlantic CEO Shai Weiss and Delta CEO Ed Bastian. The health of airline companies, the future of business travel, and headwinds facing the industry. Tune in October 23rd at 11:30 a.m. Eastern, 4:30 p.m. London time on Bloomberg Television. Context changes everything.
When you have a future that's normally in contango, it means that it's typically in plentiful supply. When that contango future flips to backwardation, it means the commodity in question is in short-term supply. There's a short-term excess of demand over supply. In this case, the commodity in question is volatility protection offered by VIX. So after sort of months of relentless volatility selling by institutions and individuals, all of a sudden they're caught a little bit offsides.
That was, of course, Steve Sosnick, Interactive Brokers Chief Strategist, speaking to Alex and me in the last hour, answering our question of the day. Is sentiment bad enough now to buy the dip? We're talking mainly about equities, but you can apply it to a whole range of asset classes as well. Sebastian Redler, Head of European Equity Strategy at Bank of America Global Research, joins us now. Stock 600's trading 434. You've got a 390 year-end target. I'm assuming your answer to this question would be no.
I would say no.
Okay, why not?
You think what gets us to 390? Yeah.
So what you have so far is you had a very strong first half of the year because you had unexpected U.S. fiscal stimulus. What you have now is the fiscal support in the U.S. rolling over. PMIs are moving lower, which means weaker underlying demand.
They've been doing that for ages, but yeah, okay.
Yeah, but it's happening now. You've got a PMI in the US at 48, consistent with minus 2% GDP growth. So you've got weakening underlying demand and the pressure from higher rates. The moment that the hard data, so the GDP growth in the third quarter was still 4%, if it catches down to this weakening underlying demand, you're going to be very quickly at 390.
So, Sebastian, all due respect, I feel like you've come on a lot and said this thing very much the same. And it's just starting to sort of prove itself right a little bit now. And I guess what gives you the confidence that, like, now is the moment?
Because I think we just did a global marketing tour. We've spoken to investors in the US, Asia, and here in Europe. Everybody expected tighter monetary policy to lead to a weaker economy. And that very much has not happened until now because you had this surprising fiscal support. What is happening now is that is starting to roll over. So this surprise factor that everybody was grappling with, i.e. why is the economy holding up, that is just moving out of the picture. So we're going from a very weird and unexpected macro environment to the typical and classical slowdown scenario. And we know what happens to risk premium. We know what happens to asset prices in that world once you go from strange and unexpected macro to the classical slowdown.
Stock 600 has been in a range for a long time now. Earnings are now coming through. This week, the earnings have been awful. You look at Nestle, you look at Roche. They're all these kind of big companies are missing on the top line. Is this finally the earnings season that delivers on the kind of narrative that you're talking? Is it showing up finally in earnings? Because earnings have been disappointing, but not that disappointing.
Yeah. I think Q3 is not going to be the real catalyst because in Q3, so typically earnings respond to the macro cycle with a lag. Q3, as we just said, was still pretty strong. You're seeing the first signs of a rollover. So what we expect is some downward surprises relative to expectations, which were already for negative growth. But the real weakness in earnings will come once you see the cracks in the economy, once activity really takes a step lower. And that's what we expect for Q4 and Q1.
Is the same, I appreciate that European strategist. But is it the same for the U.S.? I mean, your colleague Michael Harnett of B of A talked about how if the S&P can't hold 4,200, they're super bearish. That could be a contrarian signal, but if it can't hold that level, there could be imminent risks of a credit event or hard landing. Like, how does that view inform how you guys think about the U.S.?
So generally, it's the same story. The markets respond to the same global macro, the movement in risk premia. So in the scenario that we see a sharp slowdown in growth momentum as this fiscal support wears off, you see a meaningful increase in risk premia. Typically, you would expect Europe to underperform. It's more of a cyclical index, but directionally, you would expect U.S. equities to go in the same direction. So if I say in that scenario, we see European equities down 15%, then you would say slightly lower beta, but same direction, maybe 10% downside for U.S. equities. And that's pretty much Michael's view.
When do you buy the dip?
You buy the dip the moment the macro cycle has troughed. What you've effectively done in this scenario, you have put enormous pressure on the credit cycle through monetary tightening.
Yep.
The economy hasn't responded, so you have added more pressure. Then there's an additional wave of pressure from the increase in rates at the long end of the curve. Mm-hmm. And that's now going to feed through to a very weak credit cycle. The fiscal support has temporarily masked that weakness. You buy the market once you think that the last negative, and we think that we expect that to happen in Q1 next year. So 2 quarters of deceleration, weakening macro momentum, widening risk premium, falling asset prices, and then a trough in the macro cycle at some point in Q1.
Where would you buy in the market, sector-wise, then?
So the moment that, let's fast forward and assume that you go from this very strange and complex environment back to this classical slowdown scenario. The moment to buy is when risk premia peak, and then you look at the things that typically benefit when you get a snapback in risk premia when they come down again. These are the ultra-cyclical names such as airlines, autos, potentially even banks. But for you to buy, you really need to be sure.
Small caps?
Small caps are very attractive, I think, as an entry, because they are among the handful of cyclical names that have already discounted that scenario that we're looking at. Okay. We've got 3 cyclical trades in Europe: luxury goods, chemicals, and small versus large caps. They're fully priced for that slowdown scenario that we're seeing. We're market cap small caps. The moment the economy trough starts to accelerate, small caps is a very good place to go.
I'm going to jump in here.
It's you. You play ping pong. This is you.
Well, I thought I'd ask the question there, but anyway, we'll park that for the moment.
That was a comment. Didn't count.
Geopolitics. Geopolitics. How are you plugging that in? How are you thinking about the risk of that providing a near-term? How do you think about how that could accelerate, slow down, change the narrative that you're thinking about?
So in the scenario that we're looking at, the key catalyst to translate into lower asset price, defensive outperformance, as I already said, is wider risk premium. The indicator to watch is the U.S. high-yield credit spread. Now, we don't have geopolitical escalation as part of our base case. Mm-hmm. However, it's definitely a possibility, and it could happen. If it happens, it would just reinforce this narrative of risk premium at the moment being extremely tight. Does it accelerate it? It exacerbates it. Okay. You've got basically an independent catalyst that could power risk premium wider. And basically all the trades that we have in place are the ones that benefit from wider risk premium. It's basically long staples, long defensives, underweight autos, underweight banks. And this is an additional potential catalyst that could bring this risk premium move about.
Sebastian, are bonds a good hedge right now? I know you're the equity guy, but are there any bonds that are a good hedge in this environment?
I think they absolutely are. Our European rate strategists have just gone long the 10-year bunds. This is one of the many puzzles that investors have to deal with at the moment. Typically, when inflation fades strongly, core inflation in the US is down 130 basis points over the last 6 months. Typically, when the Fed comes to the end of the hiking cycle, that's when you buy bonds. A lot of our clients are tempted to buy bonds, and they're shocked by what just happened at the long end of the rates curve. Yeah. And the answers why this is happening is you still have this super strong GDP growth in Q3, so the market is busy pricing out Fed cuts. However, if our scenario comes to pass, the Fed will cut a lot more than what is in the price at the moment. The moment that happens, bond yields will come down, and treasuries are going to look like a very attractive hedge against these slowdown tendencies that we expect.
All right, Sebastian, great to hang out with you. Thank you so much, Sebastian Radler of Bank of America. We super appreciate it. Breaking news for you. Republican Jim Jordan's third bid for the GOP speakership has failed to get enough support. About 11 are against right now. They're still in the G's. You're looking at the ongoing vote for speaker on Capitol Hill. We'll get more details for you later on in the hour. This is Bloomberg.
Vicente Gonzalez. Vicente Gonzalez.
It's getting ugly out there. There's some real corners of the market that I think are fascinating. Luxury stocks have gone from sort of hero to villain in so many ways. Are they a luxury anymore that you can afford, I think is a key question when it comes to your portfolio. Certainly when it comes to actually out there on the high street, Main Street spending, the evidence is certainly beginning to move against them. Ferragamo, the latest one to come out with numbers. Its stock is being punished today. It's down by 2.6%. But you can see the reaction elsewhere. LVMH is down. We're going to get numbers next week as well. We're going to continue with these names. Hermès, Kering. We're going to continue with the data coming out of this sector. And at the moment, it continues to be a very tough trade. It's been such a reversal in that space. An area that really drove optimism about Europe has really turned into something of a braking factor. Let's turn our attention to some of the 52-week lows. Go to your Bloomberg today and look at the 52-week lows. There are just loads of them out there. More and more stocks dipping below their 200-day moving averages. More and more stocks hitting 52-week lows. Here's a bunch of them. In the chick sector, AMS, you've got Dufry down by 2.83%. Neste in the energy space down by 2.4%. Boliden, I mentioned the Nordic miner a little bit earlier on, missing today. You're getting punished for that. So it's absolutely fascinating, Alex, to see what is happening here. Just the breadth of the market, just the width of the pain is increasing, it seems, in Europe in a fairly big way right now. It's a different story stateside, and that's why I think next week is so important. With all of those big tech names reporting, and we've seen Tesla and Netflix this week, different ends of the spectrum, but next week I think it's where it really gets fascinating.
Yeah, and I mean, to your point, though, we are seeing a big pickup to the downside here in the U.S. as well. Volume is quite high on the selling. I'm looking at the S&P, literally just sitting right at that 200-day moving average. And it's really the cyclical names like regionals, oil and gas, consumer finance, autos, like all of those heavy cyclical names are really getting hit. And obviously then you're seeing them move into gold. You're seeing them move into the bond market. But again, we were talking to Steve Sosnick guy, and it's, you know, will this continue, or is this a risk off into the weekend, then we rebuy on a Monday?
We'll wait and see. Mondays, as we were hearing from Steve, very positive recently. Will that happen this week? We had a big gap lower first thing this morning in European majors. That has persisted throughout most of the day. If you take a look at it on the week, all of the sectors are in negative territory. We're down by well over now 3%. For the European majors as we come into the close. So it's been an incredibly tough week for European equities, and the earnings story is only going to continue next week. Enjoy the weekend, I guess, is maybe the message. This is Bloomberg. Can we ring the bell already? Because it's getting pretty ugly out there. It has been a tough week. It's a tough Friday. I appreciate that people are maybe lightening up. I appreciate that there's a safety story that's going on into a weekend that's going to produce who knows what. But you are certainly seeing some selling once again. And as Alex has been pointing out, stateside, the volume's good today. It's been good, actually, I think, throughout most of the week. We gapped lower first thing this morning, and the press has just been kind of there ever since. DAX is down by 1.5%, CAC's down by 1, nearly 1.5%, FTSE's down by 1 1/3. None of this looks particularly good right now. And you need to see today in the context of the last 5 days. So let's kind of start at the beginning of the week and work our way through what we've seen. Monday, Tuesday, actually reasonably quiet. Then we start to really gather pace. And actually, I think this is when the earnings story has started to sort of really kick in as well. Big names disappointing with their earnings, particularly at the top line. And I think that's just manifesting itself, as you can see, in some gap lower, some sort of gaps first thing, followed by more gaps the following morning. So we've kind of Monday, Tuesday, reasonably quiet. Then we get a gap Thursday, we get a gap Friday. And we've just gone down and down and down. Down by 3.4%, 433. It's all kinds of metrics you can look at here. None of them look particularly rosy. Today, names, Boliden misses. The miner misses. And you can see what happens. The market punishes it. Ferragamo misses. The market punishes it. No, not to quite the same degree. Tomra as well. Look at this. Look at this massive move that you're seeing in that stock as well, down by 22.59%. So if you miss, and this is just emblematic of what the story has been this week, some really big downside moves. So some, like Tomra's not necessarily there, but some really big moves, some really big heavyweight stocks that have really acted as an anchor. And I think we've just been hearing from Sebastian Redler saying actually Q3 is not where the problem's going to be. It's going to be in Q4. Or if that's the case, Q4 might not look too good. So that's the story today. What do we got coming up next week? It's going to be dominated, of course, by the ECB. But let's kind of figure out how we're going to start throughout the start the week. Consumer confidence out of the European, the Eurozone. Consumer confidence in the UK has taken the data was out today, has taken a massive hit. Are we going to see that replicated? We get back into the luxury story. Are these names, are these stocks you want to have in your portfolio? MS, Caring, sales and revenue numbers. Watch for both of those. Many people see MS as being more insulated. Is that going to be the case? Caring maybe a little bit more vulnerable. Wednesday, banks, Santander, Deutsche, Lloyds, all out with numbers. The main event of the week, Thursday, ECB. What's Christine Lagarde going to be saying about the environment that she sees in front of her? We get GDP data out. Spain, Italy. From Spain, we get Italy retail sales. The story in Italy is one you want to pay attention to right now. It's warming up. It's getting more and more difficult. The market's kind of watching, I think, the Meloni government more and more carefully. But Christine Lagarde, Alex, will be the main event. That's going to be the story next week.
Yeah, and also, if we get to euro-dollar parity, like, who's to say I'm not going to go back and support Italy's economy? So let's just keep that in mind. So let's go ahead to look at the ECB decision, talk about euro-dollar. Stephen Englander, Standard Chartered, Bank of Global head of G10 FX Research, joins us now. Cautious on the euro, pointing some more weakness if the ECB gives any hints of rate cuts ahead on Thursday. I think you said you had a 104 target, Stephen. What do you think happens next week?
Well, I think Lagarde is aware that, markets are very nervous, and I think that's going to give her a bias to be as cautious as possible. So certainly we don't expect anything on the rates move. We don't expect anything on the balance sheet. We think that that's going to come December, maybe March. On the whole, we expect her to sound very much as if she'd prefer that, you skip the meeting. I don't think that there's much that she feels she can say to, contribute to European growth or strength or anything.
Stephen, how rate differential sensitive is euro-dollar right now?
That's the question that everybody's been asking because the euro hasn't responded very much. I think what you've seen over the last 10 days or 2 weeks is that I'd say the bigger, more lower beta currencies have outperformed relative to the interest rate differential move. But you are seeing it, higher beta currencies, really, getting weaker as a consequence. Commodity currencies doing poorly. So I think that they're kind of. I think there's a bit of an underlying risk-off nervousness there, and flight towards safe havens. And Europe is it's not the best, but it's getting some of that protection. The euro is getting some of that protection.
Steve, how should we be thinking about safe haven flows into the FX market right now? Like the Swissy I get. The yen's complicated. What's the cleanest way to play that?
Well, we think it's Swiss. I mean, that just the fact that rate differentials have gone so massively against Switzerland, over the last 10 days, 2 weeks, and the Swiss is the best performing currency in G10, I think, leads you to a very strong suspicion that there's a lot of capital inflows heading into it. Obviously it's outside of the Middle East, so we think that there are plenty of people who are kind of thinking that that's an advantage at this point. So on the long side, we like Swiss. Short side, we think that Kiwi is vulnerable. Sterling hasn't performed well. There's a couple of potential weaknesses there.
Yeah, I hope that applies to the All Blacks tonight as well, Stephen. But we'll park the rugby for a moment. In terms of how you're thinking about other currency. If it's not the Swiss franc, what is it? Like a lot of people are looking at gold and the Swiss franc right now. Are there other options if you think that trade is going to start to get a little bit crowded?
I think if you're more willing to take risk, currencies like COP, some of the South American currencies seem to be relatively resilient. COP obviously is very positively, Colombian peso is very positively correlated with oil prices. So, you have to have a bit of a more tolerance for risk. But I think that there is a surge, and gold normally does poorly when the dollar is strong, and normally does poorly when rates go up, and it's done very well. So I think it's kind of holding hands with Swiss.
Can we go to the yen for a second? How do you best use the yen as a safe haven? Maybe it's not dollar yen because of maybe what's going to roll out from the BOJ, but how do you use yen as a safe haven?
I think yen is tough. It does have an exposure to oil, and if the kind of shock that you're afraid of is higher oil prices, it's unclear how much protection the yen is going to give you. Obviously the Bank of Japan is and the MOF are trying to limit yen weakness. It hasn't performed great. Euro's outperformed them over the last couple of days. It wouldn't be my first choice or second or third.
Slow down. Okay, fair enough.
Stephen, if what would be at the moment, treasuries are not performing their normal role as a safe haven, because there's all kinds of other complicated factors that are kind of coming into play at the moment. The kind of the pickup in term premium, what's happening with deficits, there's all kinds of other things being plugged into that market that means that it's not acting in the way that it normally would. The Fed's in a quiet period now, so that kind of almost removes that side of the equation. If treasuries become a safe haven again, what happens to the dollar?
I think it strengthens. I mean, I think,
But by how much?
It depends on the nature of the shock and how the world evolves and how geopolitics evolve. But I think the dollar will remain a safe haven. And I think that if we do get, the kinds of shocks we all are afraid of, that, U.S. yields will come down. I mean, that ultimately the money will go into the U.S. Plus, we're already seeing, Fed concerned, the regional banks aren't doing very well today. There's all sorts of things in the background that make you think that in their heart of hearts, they really don't want to see yields going up more. They just don't want to say it outright.
Steve, before I let you go, we've seen obviously a lot of volatility in the bond market. Volatility seems to be picking up a little bit in the equity market with the VIX at 20. Do we see that kind of volatility feed through to the FX market?
It's possible. So far the indications of risk off, and we've written about this. It's not like the VIX went to 30. It's not like you're seeing corporate bond spreads going to the moon. You do see it in gold. You do see it in Swissy. I think if these fears, turn out to be justified, if the world's a lot worse a place than we expected it to be, I think we will see FX vol really pick up. But I think right now it's doing what VIX is doing, kind of nowhere until it sees which way how things evolve.
Yeah. Little pickup now, just starting to begin to happen. You do wonder whether that move's got momentum. Stephen, have a great weekend. Thanks for joining us. We really appreciate it. Stephen Englander of Standard Chartered. If you're worried about your portfolios, maybe look away from the screens right now. FTSE 100, DAX and CAC 40 all under significant pressure going into the close through the auction. These are the final numbers. It's been a very ugly week. It's basically been one-way traffic today. And we finished not quite at session lows, but very near them, a tiny tick higher during the final few moments, but not much of one. So those are the final numbers on the week. We've broken some key areas this week. Certainly the SOX 600 going through 440 was a moment that you wanted to pay attention to. What are we going to do next? We're going to talk about what's happening in the solar sector. It has had a very tough day. A sales miss from Solar Edge having a ripple effect across the entire sector. We'll talk about it next. This is Bloomberg. This is Bloomberg Markets. You're looking live at the Principal Room. Coming up, Kate Moore, BlackRock's head of thematic strategy, joining Bloomberg Television at 3 p.m. New York time. This is Bloomberg. Solar stocks having a very dark day, certainly taking a hit in the United States and, by extension, in Europe. This after SolarEdge reported its preliminary Q3 sales results that came in significantly below the street's estimates. You can see the reaction in the stocks on both sides of the Atlantic. They make ugly reading. Joining us now is Rob Bonnet, Senior Renewables and Energy Analyst for Bloomberg Intelligence. Rob, what is this? What is the underlying story here? I remember during the European energy crisis, every single CEO you spoke to wanted to put solar on their roof. The energy crisis has gone away. Is this the kind of opposite and equal reaction to that story?
Well, the fundamental backdrop in solar still looks pretty good, actually. So we're probably going to see global solar demand increase by more than 50% this year. The problem that we're seeing in Europe, though, is that inventories got really bloated, and we're seeing a destocking phase occur right now with Enphase and perhaps some of the other companies exposed there. And higher interest rates are, particularly on the residential side of the equation, pumping the brakes a little bit on the demand on that specific segment.
So, Rob, where along the chain of solar is the kink that we're seeing?
Residential. So utility solar still looks pretty robust. If you look at a company like First Solar, they're roughly flat, down a tad today. Nothing like the kind of movement we've seen in SolarEdge and Enphase. And what's the story for them? Well, they're more geared to the U.S. market than Europe, for example. And they're also, they have a massive backlog that's locked in multi-year kind of thing. So as the residential space goes, so do SolarEdge and Enphase here at the moment.
Rob, I'm assuming we must have expected this to a certain degree. Why is it so much worse than the market was anticipating?
Well, it's never fun when you have to announce that you had orders canceled. So they are literally at the point where they are saying things are there's so much inventory out there that their customers are calling and saying, don't ship us any more product. And so I think we've been anticipating the slowdown. To give you some sense of the framing for SolarEdge, they grew their sales 58% last year, a quintessential growth type stock. This year, they had a pretty strong 1H. Their sales grew about 40% in the first half of the year. Now, when we look at the full year, though, maybe they only get 5 to 10% uplift, and right, so that's just a big shift in expectations, even though we knew the slowdown was on the horizon.
Yeah, and then it goes from like inventory now to gross margins. Goldman downgrading the stock, saying it's 1,000 basis point move in margins. Like you just can't manage that. Hey, Rob, good to see you. Thank you so much. This is going to be an ongoing story with rates higher too. The space going to get very difficult. Just look at wind in Europe. Rob Barnett of Bloomberg Intelligence. All right, coming up, another round of House Speaker vote is underway. Congressman Jim Jordan is lacking the votes to grab the seat. We're going to get more on that next. This is Bloomberg.
Jordan. Wexton. Jeffries. Wild. Jeffries. Williams of Georgia. Jeffries. Williams of New York. Jordan.
The day evolving here for the equity market looks pretty ugly. We're now sitting at 42.41 for the S&P, although off the lows marginally. Abigail's tracking the moves for us. Abby?
The selling is on above average volume too, Alex. Right now we're looking at, or at least the last time I looked a few minutes ago, it was I think about 20% above average. So this selling the sellers are real, 4 days down in a row. On the week we also have declines for the S&P 500 and the NASDAQ of greater than 1%. The VIX, these volatility indexes, the VIX on the day down slightly, but on the week higher, back above 20, suggesting that investors are waking up to uncertainty and wanting to, at a minimum, hedge it. And then the NASDAQ 100 VIX, that spread remains, but it's tightening. The VIXen pulling up the VIX to some degree. Now, if we switch up the board and we take a look at the worst sector on the week, consumer discretionary, down 4.2%. This has a lot to do with Tesla. Tesla, of course, that disappointing report, the outlook not great. And then we also have Booking.com and Amazon. Amazon reporting next week. weighing on the index. All of this has the S&P 500 doing what the Russell 2000 did maybe 2 weeks ago or so. This is the S&P 500 on the year or over the last year. Overall, a nice uptrend. You can see the 200-day moving average in yellow going higher. Those are the long-term buyers. But take a look at the S&P 500 hitting down. We have a mini death cross here with the 50-day moving average rounding down, telling you that the near-term buyers, they are not buying the dip. They are, in fact, selling even on the selling pressure. We probably go below that 200-day moving average, similar to the Russell 2000. Russell 2000 down 15% from its July peak, maybe an idea of where we go. And what is the pressure, Guy? Well, if we take a look at rates, yields on the year, this is just extraordinary. What we have here, the 2-year yield, the 10-year yield, the 20-year yield, and the 30-year yield, especially this longer part, all up more than 1%. And not that we look at the 20-year yield all that often, but with the 2-year yield and the 20-year yield, we actually have a normalized yield curve, Guy. So throw that into the mix.
Pancakes. That's what we're talking about. Pancakes. Abigail, thank you very much indeed. What are we watching into the weekend? Cleveland Fed President Loretta Mester speaking at the Manhattan Institute. UAW President Sean Fain. I think he's going to be updating us on negotiations with the automakers. And in a few minutes at noon, we think New York time, President Biden meeting with the EU's Charles Michel and the President of the European Commission, Ursula von der Leyen. That's happening, Alex, we think, at the White House.
Yep, what's also happening in D.C. right now is the third round of House speakership vote with Congressman Jim Jordan. It looks like he's officially lost. However, the vote count quite important. Bloomberg's Kaylee Lyons is down in Washington. All right, Kaylee, what's the count?
All right, 25 against Jim Jordan in this third round of voting. That is a greater number than the second round, which, of course, was 22. In the first round, 20. He has bled support each time he has gone to the floor. Granted, it's only been 3 times. It took 15 rounds for Kevin McCarthy to get the gavel back in January, but things are going in the wrong direction for the speaker nominee of the Republican Party at this point. We'll see ultimately when the gavel actually goes down. They haven't finalized the vote count yet, but this is actually a smaller number of additional supporters fleeing Jim Jordan than maybe was previously expected heading into this vote. We thought the number could actually be significantly greater than 22, and only 3 additional were added to that tally at 25. So we'll see where Jim Jordan decides to go from here. If he wants to push through to another vote today, a number of members have suggested they plan to be here voting this weekend.
Kaylee, the president is saying that Congress has a job to do. Is Congress up to that job right now? Just kind of bring these two stories together for me.
Half of Congress, guys, sure. The Senate is fully functional. They actually passed unanimously yesterday a resolution to support Israel and condemn Hamas. But the Senate, as we know, is only half of the 2 chambers of Congress, and they can't independently pass legislation. So when the president sends Congress that $100 billion supplemental funding request, not just for Israel, but for Ukraine, Taiwan, and border security as well, it's not going to be able to get through until there is a Speaker of the House. The Speaker pro tem at the moment, Patrick McHenry, only has limited power, really just to oversee the election of a new Speaker. It's not thought, including importantly by Patrick McHenry, that he has the power to bring legislation to the floor and conduct the usual business of this body. So until we get a speaker, that funding request, frankly, is not going anywhere anytime soon.
So, Kaylee, Terry Haynes of Pangea has been talking a lot about the fact that McHenry can actually get things done, but both parties are choosing not to do that. What power does he have, or what would he need to look for to be given to then move things along?
Well, Alex, the issue is it's really unclear because no one has ever been in Patrick McHenry's position before. These rules were written post 9/11 to make sure the government continues in the case that there was not a Speaker of the House. But Patrick McHenry himself views his powers as limited. He thinks really his only job is to oversee a Speaker election. He has told members that he will not act on anything unless they give him specific authority. And that's what the Republican conference was discussing yesterday for hours in the basement of the Capitol. Resolutions that would expand the power of McHenry for at least a certain period of time, but there was not adequate support among the Republican conference for that to go forward. It basically died yesterday. We'll see if it gets revived if Jim Jordan continues to lack the 217 votes he needs to get the gavel.
It's going to be an interesting few days. Kaylee, thanks for keeping us up to date. Kaylee Lyons joining us from Washington. Alex, I'm going to get on a plane. I'm going to come and see you. Monday, I shall be there. I will not be alone, of course. We're going to be joined by the Virgin Atlantic CEO, Shai Weiss, Delta Airlines CEO, Ed Bastian. I have to say, I still believe, and maybe I'm biased in this, if you want to know what's happening in the world, you ask an airline CEO. Everything that is happening right now touches this industry in a massive way.
So I kind of wanted to disagree with that and be like, no, it's oil people. But then I thought about it and I'm like, no, it's really airplanes. And Guy's been working on this for a very long time. So I'm very excited this is going to come to fruition. You're going to be right here next to me on Monday. Very much looking forward to it.
I am really
safely.
coming to see you.
Yeah.
I'm really coming to see you. That's obviously the reason why I'm coming.
He will have lunch with me on Thursday.
To do with this interview.
Travel safe. This is Bloomberg.